The average global container shipping rate has tripled in the past year. Freight rates on some maritime routes are on track to reach high levels recorded during the COVID-19 pandemic. In that context, many Western retailers have shipped goods early for the year-end shopping season because of concerns about prolonged congestion at ports. Peak season has not yet arrived. Fares have increased. The scene of container ships lining up offshore to wait for their turn to dock during the COVID-19 pandemic is reappearing. Fleets of container ships and bulk carriers are sitting idle off the coasts of Singapore, Malaysia, South Korea and China. Meanwhile, many ports in Spain and elsewhere in Europe are also overloaded. The diversion of ships to avoid attacks by Houthi rebels in the Red Sea has caused port congestion and sent shipping rates soaring as the peak shipping season was about to begin. This congestion complicates logistics for retail and manufactured goods. Many importers and exporters said the most worrying thing is that port congestion could worsen in the upcoming peak shipping months. This could cause freight rates to return close to high levels during the COVID-19 pandemic. At that time, the highest price for a 40-foot container on the spot market was more than $20,000. Currently, according to shipping booking platform Freightus, in the week ending June 14th, the average worldwide freight rate for a 40-foot container hit $4,119. This level is 3 times higher than the price in June last year and is the highest level since September 2022. During the pandemic, the average freight price for this type of container is more than $10,000. CNBC News Agency noted that spot shipping rates from Asia to the U.S. increased from 36%-41% in just the past month. Ocean carriers also increased additional fees related to fuel, shipping capacity, and operating costs by about 140%. Bringing the total cost of shipping a 40-foot container from Asia to the U.S. to about $12,000 lot. According to Paul Brashear, Vice President of Global Supply Chain at ITS Logistics, container shortages and limited ship capacity force shippers to turn to the spot market. This is pushing freight rates to levels not seen since the post-COVID-19 crisis 2 years ago, he said. According to Mr. Michael Murray, Vice President of DeSales Trading, a yarn and thread wholesaler in North Carolina, USA, although shipping prices have not increased to $20,000 per container like during the pandemic, freight rates are increasing $7,000 per container shipped from Asia to the U.S. As an importer, there is nothing worse than being stuck with inventory with high shipping costs like what happened in 2022, he said. Asia-Europe spot freight rates can exceed $20,000 container. Getz Alibrand, head of shipping at DHL Global Forwarding Americas, said shipping rates may not cool down until Lunar New Year 2025. In a recent report, consulting firm Sea Intelligence predicted that spot freight rates on Asia-Europe shipping routes could exceed $20,000 per container due to the impact of the crisis in the Red Sea. Sea Intelligence estimates that, if per nautical mile rates reach similar levels during the pandemic, spot rates will reach $18,900 per 40-foot container from Shanghai to Rotterdam, Netherlands, $21,600 container from Shanghai to Genoa, Italy, and $21,200 container on the return route from Rotterdam to Shanghai. Port disruptions come alongside a series of other events that also add to supply chain challenges. Some U.S. importers placed orders early before the new tariffs took effect on goods from China. In May, Washington announced a tax increase on a series of Chinese products from electric vehicles to masks and medical needles starting next August. The Panama Canal Authority, the 82 kilometers long waterway in Panama connecting the Atlantic Ocean with the Pacific Ocean, has restricted ship operations because of low water levels due to drought. In the U.S., many retailers and manufacturers are worried about port workers' warnings that they will strike next October if results are not achieved in wage increase negotiations. Port congestion could get worse if more U.S. importers decide to ship goods early to avoid higher costs and further delays later this year, shipping experts say. What we are seeing is a surge in cargo volumes as shippers book shipments earlier and with more containers than usual. This is an effort to pre-ship inventory and minimize the risk of possible delivery delays, said Jonathan Roach, a container shipping analyst with consulting firm Bramer. The earnings of U.S. import companies are being affected by port congestion. Mark Webb, Chief Financial Officer of J. Jill, a clothing retailer in Massachusetts, said the company used very expensive air freight to rush items out before Mother's Day. May this month, British furniture retailer DFS Furniture cut its profit outlook in half, largely due to higher freight costs. DFS Furniture said nearly $18 million of the company's goods were delayed due to shipping disruptions related to the Red Sea.